Hi everyone, this is Dr. Pradeep Reddy, Associate Professor, SAYS University, Bhopal. Would like to bring you in this video about what is dew point analysis. Many of the students were asking about what is dew point analysis, what is the real use of it, why we have to use dew point analysis, what can be known from this. So basically, dew point analysis is also known as dew point identity, dew point equation, dew point model, and dew point method. So basically, this is a name of an US company. So which is pioneered by the DuPont Company of United States, which has identified one model with relating to the return on equity. So it is a system of financial analysis which received widespread recognition and acceptance. In those days, when the financial analysis was used to be prepared, this company has found out one model so that it became famous. And this method has been used at many organizations in order to find out the return on equity. So it was developed by the DuPont company for analyzing and controlling financial performance. So it is an expression which breaks return on equity into three parts, namely as profit margin, namely as asset turnover, and the third one as the equity multiplier. So what is this profit margin is the profitability of the company, how it is to be measured. And the asset turnover is to be measured, and with why asset turnover is to be measured is the operating efficiency of the firm. And equity multiplier is the financial leverage, how we will be developing it. So let us see here. The first one as the profit margin. So profit margin is equal to net profit by sales. This is a usual formula. Everyone knows about it. And what is net profit really is net sales minus total cost. So what is to be deducted in total cost is cost of goods sold plus operating expenses plus interest and taxes, all together called as total cost. Once again, I am repeating, cost of goods sold, operating expenses, interest and taxes combinedly together called as total cost, and it is to be deducted from net sales so that we will be arriving net profit. So this is the profit margin. And the second one is the assets turnover. Assets turnover is equal to net sales by total assets. So what is total assets? Is current assets plus fixed assets. What are current assets? Current assets like stock, bills receivable, debtors, cash in hand at bank, and stock all together are current assets. And the fixed assets like whatever we have purchased for the long-term tenure of the company like land, buildings, machinery are together considered as fixed assets. So here current assets also has been categorized inventory, accounts receivable, cash and bank balance, and current assets. So this is the assets turnover. Assets turnover is equal to net sales by total assets. And the equity the third one is the equity multiplier. So what is equity multiplier is assets by shareholders equity. So when we try out to calculate the return on equity is net profit margin into assets turnover into equity multiplier. So in the first method, we have taken profit margin. The second one is assets turnover. And the third one is the equity multiplier. So when we considering it, we have seen the formulas also. Net profit margin is equal to net profit by sales. And assets turnover is equal to sales by assets. And equity multiplier is equal to assets by equity, shareholders equity. So altogether, return on equity is equal to net profit by shareholders equity. So when a clarification comes in about what is net profit is profit after taxes. And this method altogether helps in understanding how the net return on investment is influenced by the net profit margin and total asset turnover ratio. So that is the return on investment is equal to net profit margin into asset turnover. And at a stretch, you can see in the chart what is dew-point analysis, and what dew-point chart is. Return on investment is divided into net profit margin ratio, that is net profit again divided with sales. So what is net profit is net sales minus total cost. What is total cost is cost of goods sold plus operating expenses plus interest and taxes on the one hand, and on the other hand, total assets turnover ratio is equal to net sales divided with total sales. And what is total sales is current assets plus fixed assets. Total in current assets are the inventory plus account receivables and cash and bank balance. So this is all together called as DuPont analysis. What is the main purpose of it is to calculate the return on equity. So how this return on equity can be break through is through profit margin, through assets turnover, and through equity multiplier. Thank you, everyone. I hope you have understood about this what DuPont analysis. Thank you, everyone.